Hey everyone, welcome back to the channel. James here from LAGFX. Now, I thought I'd have a new video to come out explaining market structure in more depth. I know we already have a video about market structure, but I'm still seeing a lot of people getting confused on how to properly read structure, what it means when we see structure disregarded, and what my structural laws are. So I've just thrown up a random currency pair market here, one that I've never done a full top-down analysis on, just so that it's not something I'm familiar with, and then when I go through it, I'm going to be analysing the structure, telling you what I'm seeing and how I'm using the structure to create a bias. So we're here on the Great British Pound to Canadian dollar. The reason I picked this one, I don't trade the Canadian dollar like ever. The reason I came onto this market is because I wanted to do a market that I'd never analysed before, and I knew that anything to the Canadian dollar would be a market I haven't analysed before. And then for my base currency, I just wanted to pick quite a volatile market so that I understand that there is going to be some nice moves that we can actually analyse. So it's either going to be the US dollar to CAD, but I think I've already done that one in a video, so I thought Great British Pound to CAD will do absolutely fine. So looking inside of this, I just want to give you a second to decide what you are seeing here, and what you would say about this market. So what I'm saying, and the main thing that we need to worry about, is swing points. So the best thing to do about this is to get a brush tool and draw out your swing points. Okay, so we've drawn out here the main swing points within the market. Now, we understand that every single time we've had a swing high, it has been lower than the previous swing high that is in the market. Now, every time we've had a new swing low, that swing low has been lower than the previous swing low in the market. Now, what this means is it means that the market is bearish, or the market is within a downtrend. And when the market is in a downtrend, we want the highs to be held and the lows to be penetrated, because what's happening is when the institutions are taking price into a bearish phase, what's happening is that at each of the swing high points, they are loading in on sell positions, which is why we have a downtrend, which is the reason why we can penetrate the lows whilst protecting the highs, is because the institutions are pumping large sell positions on at all of the swing highs, which is introducing a lot of supply into the market, which is allowing price to have the volatility and bearish pressure that it needs in order to break the previous low. Now, on top of this, because, for example, at the very first swing high, in this region, so at the top of this point, at the swing high, the original swing high, the institutions have sell positions. Now, they want to continue profiting on these sell positions, and they don't want to take price into a drawdown so that they can continue profiting from that position. So what they're going to do is, as price approaches back up to this point, what they're going to do is they're going to absorb the demand that was present during the correctional wave in order to keep price below the current or the past swing high, so that they can continue profiting from the sell positions they have active at the very top of this swing point. Now, as they've done here, executed large sell positions, that's brought enough supply into the market to break the previous low. Price trades back up. Demand from the correction wave is absorbed. We reverse again at a swing high point that is lower than the previous swing high in the market. Now, at this point, even more large sell positions are activated, which again introduces enough supply into the market to blow price through the previous low in the market. So what we do, we have another impulsive wave. Again, they are profiting from sell positions in this region, so they want to protect this high. They want to protect their equity and their position. Therefore, when price trades back up again, we're going to hold that high and protect that high, because the institutions still have the desire to keep profiting from these moves. Now, they're going to continue doing so until they simply just cannot introduce enough supply into the market. So another impulsive wave down, correction, impulse, correction. Now, that is another point we can come on to, dependent on what the trend is. So because we know that in this phase, the highs are being held and the lows are being protected, if that is the criteria that is being met, bearish market. So an impulsive wave is any move that takes us lower to surpass the previous low. So from the swing high to the swing low, in each of these instances, that is our impulsive wave. So impulse, 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 impulse. A correctional wave is a move in the opposite direction of the trend. So in this case, it's a move back up. That is our correctional wave, but I'm sure most of you already know this. Anyway, what is going to happen is eventually when we're in a bearish trend, because we cannot just continue following a trend for ages or for as long as we want, because eventually we are going to have built up so much liquidity to the upside, and we are going to have exhausted a lot of supply, and more demand is slowly going to be introduced. So each time we create a swing high, we're also, if you bear with me for one moment, we're also building liquidity in the market. Now, at each of these swing high points, as we stated, the institutions have positions on here, but so do regular traders of the market. So do retail technical traders. They have stop losses all the way at these regions, and each of these swing highs that we've now created subsequently from the downtrend, they hold liquidity. Now, eventually, as you see here, we've got, what's that, 5+ swing high points, which could be even more if we were to, you know, maybe identify different areas in the market. Without getting too caught up on how many there is, we just understand that all of this acts as liquidity, and it's likely that we got to a point in the market where demand was being introduced. The institutions decided that they no longer want to profit from their sell positions, and what is going to happen is the market is going to accumulate, which is evident by this entire phase here, and taking this as a Wyckoff price cycle like fashion, we've had our markdown into an oversold state of the market. If we just move this across so we can see, and then once we've entered an oversold state of the market, once supply has been exhausted, we understand that demand starting to get introduced. We have a period of consolidation. Now, the purpose of this is to the main purpose is for the institutions to now absorb all the remaining supply that is left in the market, because if they're going to reverse the market, they need to ensure that demand is in full control. Therefore, they need to absorb all supply, which is done so through bear traps and manipulations. And then on top of that, they also need to build liquidity in order to introduce more demand into the market. So the purpose of a consolidation range, or Wyckoff schematic, is to reverse the market through the absorption of supply and demand, the manipulation of the market, and then eventually the reversal and continuation in the opposite direction. So we've had, in the scheme of things, one markdown, one accumulation, and arguably the start of a mark up, or the end of a mark up, but we'll get to that in a second. Now, if we were to go on to like a 1 year time frame, we have to also understand that what we're seeing here could also be viewed, if we get rid of all of this red price structure on the side, this could also be seen as one move down, the reversal, one move back up, and then obviously here we've seen a reversal again. So we have to remember that there is also or always a higher time frame bias that we are following, and the higher time frame bias of this, even though we're on the 3 month, there is still a higher time frame bias, and the higher time frame bias is that we have had an impulse down, a correctional wave back up, and then the thing that I like here is that this should have been a protected low. So from the start here, if we just take that back one step, go back to the blue tool, this in the scheme of the bullishness that has emerged after the accumulation, we have swing low, swing high, swing low, swing high. Now, we know that if we want to continue bullishness, we have to protect the swing lows. If not, we are then showing signs that we want to invalidate that current trend. So we break the low, signs that we want to invalidate the trend. After we have then broken the low, we can say, right, price is going bearish again, but why is it going bearish? Well, because like we were saying, if we were to look at a higher time frame scheme of things, all that this would be seen as is an impulsive wave down to this point here, a small region of consolidation, a move higher, which would be this move here, and then we obviously have the displacement to confirm that currently we are hoping for price to do this in the market, put in another impulsive wave lower and break the low. So because we have that assumption, we can now assume that this low, or the lowest point in the market, or the swing low, so just to try and reference this to make it slightly easier to view, if you give me one moment. On a higher time frame scheme of things, we have swing high, swing low, swing high, and then in order for us to continue the current trend and for the institutions to continue profiting from sales, this is our final target. This is where we expect price to want to come to. So we're going to identify this as a final target, and moving forward with our bias, we're going to understand that we are expecting and hoping for price to eventually achieve that final target and trade us down to create another swing low in the market. So we have that bias. We understand that we've had an impulsive wave down, like so, correctional wave back up, and we are now starting the next impulsive wave. So let's now go down to a lower time frame to see what's happening inside of here. So when we break a protected low or a protected high, that in my eyes is what we call a displacement. So what's happened here is we have displaced the current trend, which should have been bullish in this scheme of things. We've displaced that. So what we've done is we've created new bearishness. So if we get the brush tool out again, we have a swing high, swing low, swing high, swing low. So at this current point in time, this is our current range. So we have this, which price is about to exceed. So in the scheme of this small bearishness, we're disregarding now the higher time frame scheme of things for just 1 second. If we're to look inside of this bearishness, we understand that we are currently protecting this high right here. And this is our final target, because this is the current swing low in the market in the scheme of this bearishness that we need to be penetrated. So what price is done, and this isn't the purpose of the video, but we understand that we have a heavy buy to sell in this region with market inefficiency below. So this would have been a point of interest for us. And what's happened is price has come, it's tapped into and mitigated that buy to sell, mitigated the orders in that region. So now that we've had that mitigation and a lower time frame displacement, so if we zoom in again, the move that made this displacement happen, we have impulse, correction, impulse. We've displaced what should have been a protected low. So we understand that after the tap and mitigation into this zone, we've then shown our desire to start running lower. So I understand now that arguably I would actually want this to be a protected high, because there's absolutely no reason now for price to trade as higher than this, because we've already mitigated what needed mitigating. And therefore, the institutions, once again, have initiated lots of large sell positions at a discounted price in this region, which is how we were able to reverse the market, displace intermediary trends, and start making moves lower. So we can expect that price is going to first exceed this, but overall, we understand that we want price to exceed that. So now we have our bias. We created the bias that we have impulse correction, and then we should be taking the next impulse down to this final target. So we understand that price in the long term should slowly and eventually trade us down to this region. So now that we go lower, we understand that we want to find ways to be able to sell into that final target. As we drop slightly lower and we look inside of this region, we can now refine our protected high or invalidation zone quite nicely. So we're tightening that range, because beforehand the range was actually from this high down to here. We had this entire region as a range. However, we're able to shorten that range nicely to this using structural laws alongside the knowledge of order mitigation and order flow. So we can go lower once again, and now we have our bias that we don't really want price to trade higher. We want price to continue trading lower. And now looking inside of this, where we've broken out of this region of consolidation, we've obviously had once again, swing high, swing low, swing high, swing low, swing high, and then we've come down now to create a swing low. So if we were to look inside of this, as of current, this is now our invalidation point. This is our intermediary final target. However, overall, our final target is down here. So once again, we've been able to tighten the range from that level all the way down to this level, because arguably, as of right now, there is no reason for price to need to go higher than this. I understand that through my knowledge of order mitigation. I know that above this level, there's absolutely nothing that needs to be mitigated. We've already mitigated the one order that was left in the market that needed mitigating in the first place. And since then, anything that was remaining in this region has been mitigated by this high. Anything in this high that was left over has been mitigated by this high. Anything that was left over in this high, mitigated by this high. And once again, anything that was left over unmitigated in this high has been mitigated by this. So as of current, the only region in the market that price needs to trade up to is somewhere inside of this impulsive wave lower. Anywhere inside of that is valid in order for us to continue the bearish trend that we are currently following. So we can now just go slightly lower so we can begin to view inside of this impulsive wave, and we can start to look for any zones that we believe need to be mitigated. So I'm quite liking something up at this highest point in the market, and the reason why is because we have a nice bit of liquidity built up. So a nice example here once again of inducement and momentum. We've induced a lot of buyers into the market, built up all of this liquidity. The institutions have pushed price through this level of liquidity in order to initiate their sell positions at a discounted price. So they've been able to take price higher and get the best possible selling position that they could possibly get. So we know there's institutional control in this region. I'm going to assume that it needs mitigating. And then as we go lower, we can actually start to look inside of these regions for anywhere else that also needs mitigating. So if we look inside of it and we just look at the wicks, looking at structure, which is something I can do just through my knowledge of order mitigation, understanding that wicks traded back in to mitigate that. We've traded back in a few times. Now, one region that does appear to be left unmitigated is definitely this order here, because after we've had this buy to sell, we've had no price action that comes back up to tap us in. So in my eyes, we have two zones right here that we want to look for. And now if we go to an even lower time frame once again, just look inside of here, we can see that as of current, the actual protected high here is this, because of course in this move lower, so this bearishness of this singular impulsive wave, looking inside of swing highs, swing lows, etc., we've created a high, we've come down to a swing low, but we have not penetrated that swing low yet. And until we actually break a swing low, we cannot put in place a new protected high. So what's happened is this stays a protected high. We won't pick any of these because price never came to penetrate this low, and therefore we're not able to move the protected high lower because this is still the relevant move. Now, moving forward, we see that we have failed to make a lower low in the market, or failed to break the low, which would have been the target in bearishness, which is an early sign that price wants to go bullish because it's not got enough supply in the market to continue lower. And then you can see from there we've actually been creating some form of bullish structure where we've had a move up, create a swing high, swing low, which is higher than the previous swing low in the market. So early signs of bullishness. We can now expect that because the market is starting to reverse, we can take this as our singular impulsive wave. The market is getting ready to reverse higher. So our overall bias is, now that we have identified, not fully refined these two zones, but we can go and do that at a later date. But as of right now, we have these two regions identified. So following structural laws and order mitigation alone, so looking at this, we can understand we can have a pending order at both of these regions, because following laws of my strategy, so firstly following structural laws which we have gained from doing our entire top-down analysis and understanding what price is wanting to do. Now, the last Learn to Trade video, one of the last ones, was about the importance of a bias in a story, and this is a great example. Why? Because we've been able to refine our story of the market so that we can we can tighten that range that we're looking at and make sure that we can find entries in the shorter term, but then actually look to ride those entries down to our longer term targets, which would be all the way down here, which we identified on, what was it, the 3 month, as the swing low that we expect to get broken in this bearishness. So therefore, we have these two regions that arguably price should react to, one of the two. I'm not saying it will, but it's more than likely to react to one of the two, and one of them should arguably, if we were to follow laws, play out. So we have an 11.25 to 1, or pretty much a 16 to 1 RR there. So even if the first one wasn't to play out, and we'd go -1 RR, and this one would play out, which is 15.9 RR, -1 from that 14.9 RR, we would still be coming back to. And if price was, which it's more likely to do than it isn't, but it's not confirmed, play out in this way, there we go. We have just identified an amazing trade we can get involved with, and that's disregarding the fact that when price does tap into one of these zones, we will be looking for entry confirmation and Wyckoff, which would give us the ability to refine that stop loss massively. But I just wanted to give this as an example of how we use structure to create our bias, to create our story, and then how structure actually helps us when it comes to placing our stop loss and our take profit. So we see that following structural laws, we understand that price should eventually come to tap this final target, and therefore we can always have our take profits there. Don't get me wrong, I would partial along the way and potentially only have 20% of the position running to this higher time frame point of interest, not point of interest, sorry, structural point, getting back to situation at hand. Just from being able to analyze structure correctly and then implementing order mitigation and smart money concepts on top of that, we can now find ways to refine our positions in the market, create a bias, create a story, which just allows us to take more efficient trades, take better trades, take more probabilistic trades, and have a better understanding of what's going on, why price is doing what it's done, and so much more. Because I've literally been able to explain everything that price has done in this market using structural laws and smart money concepts. Now, we can continue doing this an infinite amount of times. Obviously, I've worked down here from the 3 month to the daily. I just went from the 3 month to the monthly to the weekly to the daily. We could continue going lower to try and refine this area more, find shorter term entries, but I think I've got the point across. So if you have any questions about this, make sure to let me know, whether that be in the comments or message me privately. If you go into the links in the description, there's always our social media content and links, so you can find us there. Make sure you're in the learning lounge, because we post so much free content in there: fundamental news, market analysis, educational posts, and being in that group chat costs you nothing. Also, that group chat is growing massively, so there is a community building, and I would definitely get involved before you miss out. But with that being said, this has been a video about pairing structural laws with smart money concepts and the power that that has. Now, if you would like me to create a video showing you how we then pair Wyckoff and entry confirmation into that to make this strategy 50 times better, because this alone is a good strategy, just pairing market structure and smart money concepts. But then when we actually decide to add Wyckoff and entry confirmation and step 3 to our 3-step approach, that is when this strategy can go from getting 15 or 10 to 1 RRs to refining that stop loss really nicely and getting 30 RR, 100 RR, 200 RR, so on and so forth. So allow me to make a video explaining how we then implement Wyckoff and entry confirmation into this to make the strategy even better. Let me know. If you'd like more information on this, I do have a course live on the LAGFX website. It is called Beating the Banks. It has 3 PDFs, funnily enough: market structure, smart money concepts, and then Wyckoff and entry confirmation. Over 100 pages in total. I believe it's 40,000 words, and it is just written content showing you how to go through and do all of this, giving you the knowledge you need of how to do it, why it happens, and so much more. So take a look at that if you're interested. But with that being said, thank you for watching, and we'll see you in the next Learn to Trade video.